We Chinese love to have a gamble with our money, not just at the casinos, but also on the financial markets. But just how successful is trying to time the financial markets? Welcome to another episode of Money Matters. Before I list the 5 reasons why timing the market does not work, let's take a moment to consider a survey conducted by the Investment Education Centre. It found that 3 out of 5 adults aged 18 to 70 had invested in financial products in the previous year, with 48% investing in stocks. Foreign exchange came a distant second with only 27%, and 14% investing in funds, excluding MPF and also. Whilst the survey found that most were seeking long-term capital growth, a significant proportion at 46% were looking to make quick profits. The majority who invested in stocks had invested on the Hong Kong main board, whilst an additional 46% also invested on the Gen board as well. The average annual return they were seeking from the stocks was 19% per annum. Now, the top source of information was advice from friends, family at 86%, followed by financial websites at 73%, brokers and bank relationship managers at 63%, followed by newspapers at 54%. Less than half said they had referenced listed companies' annual reports, and then only 20% followed their company announcements. So let's talk about the 5 reasons why timing the market does not work. Number 1, information or tipsy from your friends, your family, and your colleagues. This information that you receive is publicly available information, and therefore it has already been priced into the market. Information from financial websites, recommendations from your banker or your broker. This information the market already knows, and prices already reflect this. Number 2, hot stocks are often hot for the wrong reasons, especially considering the herd mentality of speculators. Word goes around that a particular stock has been performing exceptionally well, and therefore speculators jump on the bandwagon, but often at the wrong time. This is especially true of inexperienced speculators. This is a classic case of what is called momentum investing, where speculators buy in at the wrong time, often at the highest price, at which point the price of the stock corrects and falls back down to a far more reasonable level. Speculators are lured into the excitement and the frenzy, often from tips from friends and family. Number 3, some speculators seek out cheap stocks, deciding to strike on certain stocks that have recently fallen in price without fully understanding the reasons why or whether it has a good chance of recovery. As reported by the survey, less than half the people read company reports and only 20% follow company announcements. Buying cheap is often a false economy, and the same is true when picking stocks. Number 4, speculators seek the equivalent of winning the lottery by trying to pick that one stock to win big. We often read reports of wealthy individuals winning big, examples such as Li Ka-shing's now $11 billion stake in Zoom, and in the past Peter Thiel's $500,000 investment in Facebook that turned into $1 billion in cash. Research by the Kaufman Foundation showed that the best estimate for most angel investments turns out to be 2.5 times their original investment, even though the chances of a positive return are less than 50%. For most amateur speculators, the chances of finding that a winning seed investment are very, very low, and often far lower than most venture capital companies. In fact, they simply don't have the capacity for loss, as their investments are often relied on in terms of most aspects of their personal life. Number 5, the opportunity cost for speculators is high. They often hold on to plenty of cash to wait for the right opportunity in the markets. Contrast this with an investor in a buy and hold strategy who is nearly fully invested and riding the markets. While speculators are holding onto cash, investors are already making money from the markets. This means that when speculators do make an investment, they need to make extraordinary returns just to keep up with buy and hold investors. All in all, the majority of investors should not time the market. They will simply do better in a buy and hold strategy or by tracking indices. Sometimes by trying to take a shortcut to investment success, you might just end up making a loss. Don't try to be overly clever, invest wisely, invest early, and you'll end up smelling roses. Thank you for joining me on this episode. Ask me a question about your portfolio in the comments below. Smash that like button, subscribe, and I'll see you in the next episode of Money Matters.